If I had to navigate a rally like this today from scratch, knowing what I know about how markets behave after a violent snapback, how quickly optimism can outrun reality, and how the next chapter usually rewards preparation while punishing complacency, I would do everything differently. Most people think a rally like this means the danger has passed. That's not really what this is. This is the stage where relief starts dressing itself up as certainty. This is the stage where people stop asking hard questions because green candles feel like proof, and that's usually where the real test begins. It's Friday, April 17th in New York, and before we go any further, comment the day and date you're watching from. And if you value what I do here, support the channel by subscribing and drop John AG Best in the comments, because just look at this setup. Stocks are back at record territory. The Nasdaq just ripped through a winning streak that would have sounded ridiculous a couple of weeks ago. Gold is still sitting way up near record levels. Oil is still elevated after a brutal squeeze. Inflation is still sticky enough to keep policymakers uncomfortable. The Fed is still openly saying uncertainty remains high. That is not a clean, happy, all-clear market. That is a market doing two opposite things at once. It's celebrating with one hand and reaching for a helmet with the other. And that matters, because when equities act fearless, while money still respects gold, while energy still threatens margins, while the central bank is still speaking in careful, cautious language, what you're looking at is not perfect confidence. You're looking at a market powered by momentum, positioning, and selective hope. Sometimes that kind of move keeps running. Sometimes it folds into a nasty fake out. Most of the time, if we're being honest, it finds a way to do both before it's done messing with people. That's why I think this kind of environment is unusually tradable, but only if you stop pretending it's simple. You had a sharp drop, then a very fast rebound, then headlines flipping every other hour. War risk, relief chatter, oil fear, dip buyers, short covering, a little bit of everything all at once. The tape moved so fast that by the time people processed the last scare, the market had already sprinted to the next emotion. And a market like that can make disciplined traders look brilliant. It can also make undisciplined investors feel brilliant for 3 days right before they hand everything back. So, what would I pay attention to? Not the loudest opinion, not the person who suddenly discovered courage after the rebound already happened, and not the lazy argument that says, well, the market's up, so the market must know. I'd pay attention to repeatable behavior. That's the key idea underneath all of this. In a tape this jumpy, you're not dealing with one clean trend. You're dealing with bursts, reversals, failed breakdowns, squeezes, relief rallies, profit-taking, and mechanical flows all layered on top of one another. And when markets start acting like that, patterns matter more than people want to admit. Not because business fundamentals stopped mattering forever. They didn't. But because short-term movement often gets decided before the polished explanation shows up. And let me say something clearly here, because this is where people start talking nonsense. I do not buy the idea that long-term investing is dead. I think that's lazy and dramatic. Great businesses still matter. Balance sheets still matter. Cash flow still matters. Time still matters. If you own the right assets and you can actually sit through pain, that framework still works. But blind buy and hold, with no awareness of entry, no awareness of market regime, and no respect for volatility, that's a different thing. Sometimes that's not wisdom. Sometimes that's just hoping and calling it discipline. And the reason this conversation even exists is because the market after the pandemic era stopped behaving like the old textbook version. So many people still quote, you had stimulus flood the system, you had zero commission speculation become normal, you had options activity explode, you had millions of newer traders treating the market like a live video game, you had artificial intelligence become the shiny phrase that could transform sentiment overnight. You still see it now. One shift in tone, one hotter than expected update, one mention of AI demand, and a stock can move like it drank jet fuel at breakfast. That is not the same market people are romanticizing when they talk about the old rules. So when somebody says, just relax, zoom out, none of this matters, I think that advice is only half right. Zooming out helps. Panicking less helps. But pretending the market structure hasn't changed, that's where people get blindsided. Now, the useful part of all this chaos is that volatility doesn't just create fear. It creates fingerprints. That's the phrase I'd use here. When a stock gets hit too hard, too fast, it leaves a certain shape behind. When a momentum name pulls back inside a strong tape without truly breaking, that leaves another shape. When a boring stock gets sold with everything else, even though the underlying business is still fine, that leaves another one too. These aren't magic spells, they're tendencies, they're setups. And the more violent the market gets, the more often those setups begin to flash. That's why this recent rally matters so much. Not because markets bounce all the time. It matters because the rebound came after a nasty air pocket and then kept stretching until even the people who hated it started feeling pressure to chase it. And historically, rallies like that can be real without being easy. That's the part most people miss. The medium-term direction can still be higher, while the path there remains messy enough to shake out almost everybody who came in late, oversized, and overconfident. And one more thing, because this is where headline watchers get fooled. A streak in the Nasdaq does not mean every stock is healthy. It does not mean breadth is perfect. It does not mean the economy is suddenly bulletproof. It means money has stampeded into leadership, and leadership has pulled the index higher. Those are not the same thing, so yes, momentum can carry further. But you still need to respect that this move is being held up by speed, concentration, and narrative power, not some heavenly announcement that all risk has been canceled. That distinction matters, a lot more than the average headline reader realizes. So let's talk about the three kinds of setups that stand out to me in a market like this. The first one is the fast reversal in a beaten-up travel name. An airline stock showing up here makes sense, but not for the reason most people would give you. Most people would start talking about the economy, bookings, ticket prices, jet fuel, and whether travelers are feeling rich enough to click purchase. That stuff matters over time. But for a shorter swing, the cleaner question is this. Has the stock been shoved down hard enough, in a strong enough broader tape, that a snapback becomes the path of least resistance? That's the kind of setup short-term traders love because it does not need a giant theory. It just needs pressure to release. And one reason that airline example gets interesting right now is that, according to the latest publicly available company materials, management has still been talking about stable demand from higher value customers and continued focus on operational reliability. So now you've got a very liquid stock, a bruised chart, and a market backdrop that is still trying to levitate. That combination can create quick opportunities. Not forever, not for marriage, for a trade. The second setup is almost the opposite. Instead of a flashy consumer-facing name, you look at a quieter energy infrastructure business, pipelines, storage, natural gas, the kind of stock that never wins a popularity contest. And that's exactly why it can be useful. Boring names can become beautiful when the market gets noisy. If a stock like that has been pushed lower for a couple of weeks, if it has stacked up red closes, and if the business underneath it is still quietly doing its job, then an oversold reversal can become very compelling. What makes that one more interesting is the fresh backdrop beneath the chart. From recent company updates, this business just posted record annual results, lifted its dividend again, and expanded its project backlog in a meaningful way. I'm not saying that guarantees anything. It doesn't, but it matters that the stock is not just a random object on a screen. There is a real business underneath it, collecting cash flow while traders throw the shares around. When those two things line up, boring can move much faster than people expect. Then there's the third setup, and this is the one that usually separates discipline from delusion. Speculative AI infrastructure. You already know the type. Fast grower, newer listing, big story, big expectations. The kind of chart that can look unstoppable for a while and then suddenly drop like it forgot gravity was optional. That's why names like this are seductive. They can reward you in a way the boring stocks usually can't. They can also humble you before lunch. And here's the part I actually like about that kind of setup right now. Based on recently published results, this company just delivered a massive growth year, with revenue more than doubling as demand tied to AI connectivity kept surging. So there is real business momentum there. This is not just a buzzword in a shiny jacket, but the stock is still speculative. It can still be pushed around by profit-taking, by positioning, and by crowded expectations, which means a sharp down day inside a bigger momentum story can create a fascinating opening. But this is where I want to challenge the easy sales pitch. A lot of people hear a story like that and think, well, if the growth is real and the theme is hot, then every dip is a gift. No, absolutely not. That kind of thinking is how people get buried in good stories bought at terrible prices. In fact, the smarter interpretation is almost the opposite. The more loved a stock is, the less room it has for disappointment. So if you're touching a setup like that, you do it knowing the risk is higher, the swings are nastier, and the position size should reflect that reality. Small, controlled, respectful. Because even when the long-term story is real, the short-term path can still punch you right in the mouth. And that's true for all three of these examples, by the way. None of them are promises. They're just different species of opportunity. One is the quick reversal in a liquid cyclical name. One is the quieter oversold move in an infrastructure name with a steadier backbone. One is the speculative momentum reset in an AI-linked grower. Different sectors, different personalities, different ways the market can hand you an edge. And that diversity matters because one of the most useful things about a pattern-driven framework is that it forces you to look outside your favorite sandbox. Most retail investors get trapped in the same handful of names. They stare at the same charts, read the same commentary, chase the same crowded stories, and then wonder why they always feel late. Well, of course you feel late. You're shopping in the aisle everyone else already emptied. Sometimes the better opportunity is in the stock you weren't even planning to check. And even if you are not an active trader, there's still a lesson here. Signals are not just for people trying to flip a stock in a week or two. They can also help longer-term investors with timing. If you already know the business you'd like to own, the next question is simple. Do you buy it right now, or do you wait for the tape to come to you? That alone can make a real difference. You do not need to become a hyperactive chart goblin to benefit from better entries. You just need to stop acting like every day is equally good. Now bring this back to the broader market. When you get a rally this strong after a sharp slide, the natural instinct is to ask whether the move is exhausted. Fair question. Very fair question. And I think the honest answer is that exhaustion and continuation can live in the same room for a while. That's why these periods mess with people so badly. The market can be higher months from now and still slap you around next week. That's the real lesson. After rare winning streaks, the historical pattern often points to more turbulence first, then a higher market later. Not a guarantee, a tendency. And the reason that matters is because it changes how you think. Instead of asking, is this rally fake or real? Maybe the better question is, how do I survive the shakeouts if the bigger path is still up? That's a much smarter question. So let me ask you this. Do you think this rally is the start of something bigger, or do you think it's setting people up for a nasty reset first? And second, when markets get this wild, do you prefer trading the swings, or would you rather wait for cleaner setups and miss the drama? Because either answer can work. Pretending you have no choice usually doesn't. If you're successful, share your success story in the comments so others can stay motivated. At the end of the day, this is what I think is really going on. The market is not calm, it's just climbing anyway. That's why gold is still elevated. That's why oil still matters. That's why inflation still matters. That's why the Fed still matters. The rally has real momentum behind it, but it's happening in an environment that can still throw a left hook with almost no warning. That means opportunity is real, risk is real, and lazy analysis is deadly. So don't confuse a strong rebound with a simple market. Don't confuse a hot theme with an easy trade, and don't confuse a green screen with safety. Use this moment for what it is, a chance to think more clearly than the crowd, a chance to respect volatility without fearing it, a chance to build a process instead of chasing a feeling. Because rallies like this do not usually reward the people who feel the best. They reward the people who stay sharp after everybody else starts celebrating. This is here to help you think sharper and move with more discipline. It's for education, not a buy or sell order. So do your own homework and make decisions that actually fit your risk, because your money deserves more than somebody else's excitement.